Assalamualaikum warahmatullahi wabarakatuh. So today we will present to you guys about topic 3, which is financial statement. The first presenter for today is me, Saidah Shasha Alia. Next, Farah Iwani, and then Sarah Akila, and then Emmanuel, and the last one is Nur Izzati. So table of content for today is 3.1, which is introduction, 3.2, the purpose of financial statement, and 3.3, classification of income and expenses, and the last one is 3.4, definition of profit and loss. The introduction for financial statement is financial statement, also known as a financial report, which is it is a formal account of a company financial operation and status. Relevant financial data is presented in a standardized and easy to understand format. They usually contain the following 5 financial statements, as well as management, discussion, and analysis. These are the 5 financial statements. First, a balance sheet. Second, an income statement. Third, a statement of increase in equity. Fourth, cash flow statement. And the last one is comprehensive income statement.
Assalamualaikum warahmatullahi wabarakatuh and a very good morning. My name is Farah Iwani binti Razali, Matric ID DB100137. Today I will present about the purpose of financial statement. The general purpose of the financial statement is to provide details about the performance and outcomes of operations, financial status, and also cash flow of the company. This information is usually used by the readers of the financial statements to make decisions regarding the allocation of resources. As a group, the entire set of financial statements can also be assigned several additional purposes, which are monitor the progress of the business. Business needs to maintain a good records to monitor their progress of the business. By having a financial statement, it can show whether the business is improving or not. Number 2 is identify the source of income. Money or property can be received from many different resources. Financial statement can help to determine and identify the source of the income and separate each of the business income. Number 3 is financial performance. It can serve as a conceptual framework for all the entities who provide the financial performance of the company. Next, as an investment decision. It can be used for the investor to know the company's financial stability and they get financial assessment and take important decisions of the company. Overview future cash flow. This can provide an overview of the future economic performance and any future risks of the company. And lastly is taxation decision. Usually, government entities tax a business based on its assets or income, and they can obtain this information from the financial statement.
Hi, I'm Emmanuel, and I'm presenting 3.3 Classification of Income and Expenses. Definition of single-step income statement. A single-step income statement presents the revenue, expenses, and ultimately the profit or loss generated by a business, but it reports on this information by using just one equation to calculate profits. The equation used in a single-step income statement is net income equals to revenue plus gains minus expenses plus losses. The single-step income statement offers a straightforward accounting of the financial activity of the business. It is easy to understand and relatively easy to prepare. Definition of multi-step income statement. A multi-step income statement reports much of the same general information included in a single-step income statement, but it uses multiple equations to determine the net income or profit of the company. The multi-step income statement uses 3 different accounting formulas to arrive at the net income. First one is cost of goods sold is subtracted from net sales. This gives the gross profit. Second, operating expenses are subtracted from gross profit. This gives the operating income. Third, Operating income is added to net non-operating revenues, gains, expenses, and losses. This final figure gives the net income or net loss of the business for the reporting period. Next, the table shows section of multi-step income statement. There are gross margin section, operating expenses section, and non-operating expenses section. Advantages of single-step and multi-step income statement. For single-step, it is easy to prepare because it requires to make fewer calculation and because they don't break down operating versus non-operating line items. Single-step reports take less time and effort to prepare. Secondly, it's easy to read and it is streamlined document. It focuses on the bottom line, net income, so it's easy to see at a glance how well the business is performing financially. For multi-step income statement, it offers greater detail and itemized breakdown of a business revenue and expenses, categorized by operating and non-operating revenue for more insight into the financial health of the company. Secondly, report gross profit is an important metric because it shows how efficiently a business uses labor and supplies to generate revenue. And lastly, report operating income on a company's operating income, which gives insight into how efficiently a company earns a profit from its primary business activities. Here are some examples of single-step and multi-step income statement.
Next, I will continue the presentation on the classification of expense, which consists of definition, type, different, and example of expenses. The first presentation is on the definition of expenses. An expense is the reduction in value of an asset as it is used to generate revenue. If the underlying asset is to be used over a long period of time, the expense takes the form of depreciation and is charged ratably over the useful life of the asset. If the expense is for immediately consumed items such as a salary, then it is usually charged to expense as incurred. Next is the type of expenses. There are several types of expenses. The most common way to categorize them is first, operating, second, non-operating, third, fixed, and last is variable. Below is a table regarding the type of expenses, which include four types, namely operating, non-operating, fixed, and variable. In column of operating is marketing, advertising and promotion, salary, benefit, and wage, rent, and insurance. The second type is non-operating, is interest, tax, impairment charge. For the column fixed are rent, salary, benefit, and wage, sometimes fixed and sometimes variable. The last column for the type of expenses is the variable, that is transaction fees. Next is the difference of expenses and capital expenditures. The difference between expenses and capital expenditures is an expense has been recognized under the accrual principle and is reflected on the income statement, while for capital expenditure goes straight to the balance sheet as an asset. For the last subtopic in my presentation is the example of expenses. Common expenses are as follows: is first, cost of goods sold, second, rent expense, third, wage expense, and fourth, last is the utilities expense. For the last presentation is, here I provide an example of expenses from Amazon company. Below is an example of Amazon income statement for 2017. Amazon has listed their main expense categories in the income statement. Amazon has separated their costs into two categories, namely operating expenses and non-operating expenses. Operating expenses consist of sale, marketing, fulfillment, technology, content, general administrative, and other costs. While for non-operating expenses include interest expenses, is income and other expenses. Amazon has imposed a provision for income tax and contribute investment activity method of handling investment or called equity method. That's all from me. Thank you.
Hello, I'm Nur Izati. I will present about definition of profit and loss.
Hi, today I am very happy. You know why? Oh really? What happened? I bought flowers for 40 ringgit and sold them for 60 ringgit. So I got 20 ringgit extra. Oh really? That's great.
Did you hear conversation between them? There you can find that she got 20 ringgit extra. In financial concept, what does it mean? It's nothing but a profit. A transaction is the commercial dealing in which goods are purchased or sold. Whenever a purchase or sale is made, the seller make either profit or loss. What is profit? Profit is the excess money gained over the cost price. If selling price greater than cost price, then the seller can say to have a gain or profit. What is loss? A loss is an excess of expenses over revenue, either for a single business transaction or in reference to the sum of all transactions for an accounting period. There are two distinct kinds of profit and loss problems. Those in which profit or loss is based on cost, and those in which profit or loss is based on selling price. Profit and loss accounting is a fundamental way to measure the financial performance of a business. Profit and loss based on cost is when a percent of profit or loss is given, it is understood, unless stated to the contrary, to this percent is based on the cost. Thus, if someone states simply that he or she sold something at a profit of 10%, it is understood to mean that it was sold for an amount equal to its cost, plus 10% of its cost. To find the percentage of profit or loss, divide the amount of profit or loss by the cost. Let me give some example. Example number 1. A toy that costs 18 ringgit is sold at a profit of 20 ringgit. Find the percent of profit. Okay, the method is the amount of profit divided by cost, then we got the percent of profit. So, 20 divided by 18. And to quote percentage, multiply with 100. So, for this situation, the percent of profit that we got is 25%. Example number 2. A book that costs 100 ringgit is sold for 18 ringgit. Find the percent of loss. First step, cost minus selling price equal to amount of loss. The calculation 100 ringgit minus 18 ringgit equal to 20 ringgit. So, the amount of loss is 20 ringgit. Second step is to find the percent of loss. Okay, the method is the amount that we lose divide by cost, then we got the percent of loss. So, 20 ringgit divide by 100 ringgit, and to call percentage, multiply with 100. So, for this situation, the percent of loss that we got is 20%. Profit and loss based on selling price is the modern accounting practice favors the basing of profit and loss on selling price rather than on cost. This is because commission and other selling expenses are figured as a percentage of selling price, and it also simplifies accounting to base profit and loss on selling price. To find the percent of profit or loss, divide the amount of profit or loss by the selling price. Let me give some example. For example number 1, a candy bar sells for 13 ringgits at a profit of 6 ringgit 50 cents. What percent of profit on selling price does this represent? Okay, the solution is the amount of profit divided by selling price, then we got the percent of profit. So, 6 ringgit 50 cents divided by 13 ringgit, and to cut percentage, multiply with 100. So, for this situation, the percent of profit that we got is 50%. Example number 2. On every radio selling for 14 ringgits, a merchant lost 8 ringgits. What was his rate of loss on selling price? The solution is the amount of loss divided by selling price. Then we got the rate of loss. So 8 ringgits divided by 40 ringgits, and to cut rate of selling price is multiply with 100. So for this situation, the loss of selling price that we got is 20%. That's all from us. Thank you.